been saying is you think that the Ethereum network or market cap is going to flip with Bitcoin. Now, Bitcoin is at about, what is it, 2.4 trillion now, somewhere around there. And Ethereum is 540 billion. You think there is a flippening, as they might say. I'd love to hear you talk about it, but just to set this up, anyone who's listening to this podcast knows that we have in 2030 a forecast of the entire crypto asset ecosystem. And of course, we're going to be modifying this with time. We're doing our big ideas work now, but as of our last go at this, the ecosystem we expect to hit $25 trillion in 2030. The vast majority of that in Bitcoin, mostly because we look at Bitcoin as a global monetary system, rules based that we've been missing since the U.S. went off the gold exchange standard in 1971. That's a very big idea.
Cathie sets a massive frame. Bitcoin as rules-based money sits at the center of her outlook. Yet the challenge on the table is whether Ethereum can overtake it. Our story follows how Tom answers that challenge, not by tearing down Bitcoin, but by arguing that a different kind of dominance is emerging. Think less store of value and more platform for rebuilding financial rails. The tension lives in that difference.
Well, if I could rewind a little bit to 1971, in our chairman's message last month, we addressed how gold versus Wall Street grew post 1971. So 1971 was when Nixon formally withdrew the U.S. from the gold standard. The immediate beneficiary was there was demand and a market to own gold. And so people would say that was your, first implication.
Tom reaches for history to show how a monetary shock can reorder winners. When the anchor came off, gold surged, but the real long game went to financial plumbing. That is the lens he wants us to use for Ethereum. If Bitcoin is digital gold, the next question is who becomes the new Wall Street. Tom believes that is where Ethereum steps in.
But what we wrote about and talked about in our message was that in 1971, the dollar became fully synthetic because it was no longer backed by anything. And so there was risk that the world would go off the dollar standard. So in stepped Wall Street to create products to propagate the future of Wall Street, including, and we listed, I think, 14 products that emerged over the next decade, from money market funds to credit to mortgage-backed securities to futures, etc.
The playbook after 1971 was productization. Financial engineers met a vacuum with tools and rails. Tom is mapping that same dynamic onto blockchains. The key is not ideology, but infrastructure and incentives. Where the building happens is where value congregates.
And dollar dominance by the end of that period went from 27% of GDP terms, but to 57% of central bank reserves and 80% of financial transaction quotes. So Wall Street created products that made the dollar dominant, and the market cap of equities today is 40 trillion compared to 2 trillion for gold. So in other words, gold is 5% of all available assets.
That comparison matters for the flippening debate. A superior store of value is not the same thing as the platform that routes transactions and issues assets. Gold kept its aura, equities won the world. Tom is suggesting a similar split between Bitcoin and Ethereum. One can win status while the other wins surface area.
And so in 2025, we think everything is now becoming synthetic or tokenized, not synthetic. So as we move not just dollars onto the blockchain, which is stablecoins, but we'll move stocks and real estate, dollar dominance is going to be the opportunity of Ethereum. So digital gold is Bitcoin. And so in that world, we believe Ethereum could flip Bitcoin, similar to how Wall Street and equities flipped gold post 71.
Here, Tom names the catalyst. If tokenized dollars, stocks, treasuries, and property migrate to neutral smart contract rails, the network that settles and composes them can outgrow the asset that anchors value. It is not anti-Bitcoin. It is pro-market plumbing. That is the heart of his flip thesis.
Now, that is just our working theory because I am still a Bitcoin bull. So I'm very bullish on Bitcoin, and I believe your targets for Bitcoin are actually reachable. So we think Bitcoin fair value should at least be 1.5 to 2.1 million, but we can see higher values. But that would, of course, provide upside to a neutral smart contract platform where a lot of Wall Street will innovate of real world assets.
The debate is not zero sum. Tom explicitly places Bitcoin on a path to dramatic appreciation while still arguing that Ethereum's utility surface could surpass it in network value. This is an ecosystem view. The flippening, in his telling, comes from complementary strengths, not conflict. That nuance matters for investors weighing allocation.
And then MicroStrategy came along. So MicroStrategy is almost 2.0 as Bitcoin Treasury. What he's done successfully, of course, is really to upscale it so rapidly because he went from having $2 of Bitcoin per share to over $250 per Bitcoin share, per MicroStrategy share today. So he has created enormous shareholder returns because the security business, of course, has continued to really muddle along at basically zero growth.
Tom uses MicroStrategy to show how capital markets create bridges when mandates block direct ownership. That is crucial context for Ethereum in 2025. When the market wants exposure, it invents vehicles and migrates liquidity to the easiest rails. If policy winds align, the rails with the most composability can compound faster.
In Ethereum, I think the moment is really this year, because this is the year that Wall Street and governmental regulations became friendly to think about rebuilding on the blockchain. And part one, of course, was the stablecoins, and stablecoins have really been the breakout hit in crypto. We coined it as the ChatGPT moment for crypto because it has become a breakout product. And it has created two enormous companies, one being Circle, which I know ARK was an anchor investor in the IPO, and the other is Tether.
Momentum hinges on product market fit. Stablecoins gave institutions a simple on-ramp to on-chain dollars and payments. If those dollars live natively on Ethereum and other neutral chains, liquidity and developers follow. The thesis becomes less about narrative and more about network effects around real usage.
Tether today is raising money at a $500 billion valuation and roughly 300 employees. That's about $1.7 billion of market value per employee.
Yeah, we featured that. We featured that, Tom, in last year's Big Ideas because we said, oh my goodness, at the time it had 180 employees. We said, there's never been anything like this before, right?
Yeah.
Efficiency at crypto-native financial firms underscores Tom's point. When banking functions can be abstracted by code, margins look unlike traditional finance. That kind of operating leverage favors programmable platforms that host stablecoins, tokenized treasuries, and settlement layers. It is an argument for where profits and then valuations can concentrate.
And so JP Morgan, who just $869 billion, has 313,000 employees for 2.8 million of value per employee. Tether is showing you a crypto native bank is fundamentally vastly more profitable. And that's what I think is happening on smart contract blockchains that are neutral, like Ethereum and Solana. But it really only could have started in 2025.
That comparison sets the stage for scale. If the rails with the best neutrality and composability host the most profitable primitives, investors will re-rate those rails. Tom is not promising a timeline, but he is pointing to an operational frontier. Ethereum's case is that it already hosts the most builders, assets, and standards to catch that wave. We explored how Cathie frames Bitcoin as global rules-based money, and how Tom argues that Ethereum's value could surge by becoming the settlement layer for tokenized dollars, treasuries, stocks, and real estate. We tracked the historical analogy from 1971, where gold won aura while equities won dominance, and applied it to crypto where Bitcoin can appreciate while Ethereum amasses activity. We looked at MicroStrategy as a bridge that unlocked capital flows, and at stablecoins as crypto's breakout product pulling institutions on-chain. We noted how crypto-native financial firms reveal a profit structure that favors neutral smart contract platforms.
Now, that is just our working theory because I am still a Bitcoin bull. So I'm very bullish on Bitcoin, and I believe your targets for Bitcoin are actually reachable. So we think Bitcoin fair value should at least be 1.5 to 2.1 million, but we can see higher values. But that would, of course, provide upside to a neutral smart contract platform where a lot of Wall Street will innovate of real world assets.
So where do you land after hearing both sides? Does Ethereum's neutral smart contract economy eventually outweigh Bitcoin's role as digital gold? Or does Bitcoin's monetary premium keep it on top?